Hey guys, this is Chris with investingwithchris.com, and real quick, and again, I wanted to share with you a valuable lesson on how stocks are traded and just exactly how the prices work when going upon the stock market and trying to buy shares or sell your shares. Now, the first and foremost thing that you must understand is exactly how those shares are priced. Understand last price sequence means that if a buyer is selling their shares, it goes based off the last price, and that is how it's readjusted in that price when you go to sell it, and how it's determined for that next buyer. To make things more simple, I want to show you a visual just on exactly when a company goes public and how it determines, or basically the valuation model of when shares and how they're priced. Real quick, say a company is worth, or they're saying that their company is worth $1,000 and they decide to go public onto the stock market. The owner would still maintain and control his side or his portion at least 50-51%. This is the entire company model, right? You got a whole piece of the pie here. The company's, just for evaluation purposes and visual, for a visual model, we'll say that the company is worth $1,000. Now, the owner would give up his 50% and throw in 50%, which would be what, $500. So let's say the owner, his name, let's use my name, Chris. And on this side is the public, and you have, let's just say 3 investors and shareholders. This one would own 2, let's say this one owns 1, and this one owns 2. Let's say that this one is Carl, Susan, and Bob. Carl and Bob owns 2, Susan owns 1. What would the cost or the price of their shares be worth? You would total $1,000. Carl's would be $200, $100 each. Susan's is $100, and Bob's value is $200. 2, 1, 2, and mine would obviously be 5. Let's say that Susan no longer wants to be into this company and be an investor anymore. She wants to enjoy her life. She decides to sell her 1 share. And let's say the buyer on the other end, where there's a buyer, there's always a seller. Where there's a seller, there's usually a buyer. I'm not going to get into the advanced of what market makers are and how they work when they cannot find a buyer or a seller. We'll stick to the basics. That will be taught later on. I just want to show you this method, or this lesson real quick, and to understand how stocks are priced and sold. So let's say Susan finds a buyer and she sells it for $200. That means her price or her profit has doubled. So now this 1 share is worth $200, and the new buyer is Jim. So what happens to everybody else's shares? They double in value as well. So Carl's is now worth $400, and so is Bob's. And so is mine, up to $1,000. So that's how it works. If Jim was to sell his shares and they too doubled, then everybody else's value or those shares would again double. And same thing on the downside. If it lessens, then it would lose value. Just the same method. So that's how a company, when it becomes public, how the prices adjust between buyers and sellers. You have to think of it as in, when you buy a share, you're buying a piece of the company. The more shares that you buy, the larger piece that you own. Now, I want to have you to understand that when you buy shares, you are owning a piece of that company. It does not mean you could walk into the company and fire people, hire people, and whatnot. But with some of these stocks, you do have voting rights. You do have the ability to collect dividends, and what are dividends is every profit on the dollar. Companies sometimes give that back to the shareholders. But with voting rights, you do have power to elect new board members and whatnot. So I hope that helps. I'll see you in the next video. If there's any other questions, drop them down in the comment section, and I'll try to cover that in the upcoming videos. Thanks.